for a long period of time. Jeetu Panjabi, good morning. Thank you for joining us. I've used all typical adjectives which long-time investors use. Markets can remain irrational longer than you can remain solvent. Markets can surprise you, markets can shock you, and markets can even disappoint you. How things been at your end? Are you surprised, shocked, or are you in now sync with the reality that next 2-3 quarters are going to be painful and full of grind?
Well, you have to realize that is the new reality, but also on an optimistic note, if you go out and see the template of what's happened in China, what's happened in Korea, what's happening in some of the European countries, there is a template for recovery. If you look at what happened for 4 days between 1st and 4th of May, for Chinese air traffic, it was 30% of normal. You're seeing Australia, New Zealand air traffic has opened up. You see road traffic in a lot of countries in Asia has sort of come back to 70, 80, 90% of normal. So the simple point I'd make is, yes, it's painful. Yes, it'll take a while. Yes, we have to coexist. But there is a path to normalization. And the market keeps throwing up opportunities because market's looking at 3 and 6 months. And if you look out 18 months, that's going to throw up a lot of opportunities.
What do you make of the government package? So far, it has really talked about opening up the credit, helping out poor, addressing the poorest of the poor. There is no clear mention of what would be the capital infusion from the government or what would be the government spend in terms of kickstarting the economy. So while the blueprint is great, but there is nothing which could be called as an out-of-box idea or nothing which could be talked about, a measure which could stimulate the economy very, very smartly.
Absolutely, Nikunj. I agree with you on this point. The point is they've done very good stuff for the migrant labor, for the rural, for the urban poor, providing housing, providing food, trying to work on all of that, plus a lot of the liquidity and credit guarantees out there. I think they've done a lot. And I think you have to assume that's their number one priority. But the bigger issue is how do you get growth going? And the simple point I'd make is that fiscal monetization has been legitimized in the Western world, in Japan, in the US, even in Indonesia. So the simple point is you should not be afraid to go out and have the RBI print. You borrow from the RBI and go and spend and do not worry about the fiscal deficit. I think, as I understand, there are a fair amount of concerns in the system on what will the credit rating agencies say, how will they view it. And the point I'd make is you got to worry about your 1.3 billion people. You need to worry about bringing back jobs. You need to worry. And capital in India, foreign capital in India is pro-cyclical to growth. So if you're going to keep worrying about a rating agency saying, I'm going to downgrade you, you're doing yourself harm. There's going to be less capital that comes in. Now, what do you use that for? In my view, that the two big sectors that are large employment generators, one is the real estate and second is the automotive sector. So what you did for housing, for the 8 to 16 lakh income bracket, you got to make it broad-based. Anyone who buys a house in the next 10 months is interest-free from a financing perspective for 2 years. You're going to see a lot of money come in and people are going to buy apartments. The same thing you do for autos. As these two sectors come back, 85 million people get jobs. They come back into the market. You drive the steel, the cement, the transportation, a lot of other sectors, and the economy comes back. So the simple point I'd make is there's a huge opportunity. Fiscal monetization has been legitimized. And you have to provide a growth impetus by making the people who have money in their pockets come out and spend. That gives the people who don't have jobs, and that gets the economy going.
Jeetu, let's talk about the other problem. And the other big problem is that there is a lot of liquidity in the system and banks are not lending. People are desperate to get loans, but banks currently I understand is that they are not even releasing the pre-COVID approved loans. What could be the mix? I mean, RBI cannot force banks to lend. They can only request them to prioritize it. Till the time lending will not pick up, whatever government is trying to do, if the credit offtake is low, the economic activity will not start. And frankly, there is no easy solution. Every time we speak to bankers, they are saying, look, we are risk averse because we are afraid of the economy and NPAs will come back. What is the middle path? I mean, who is going to do the heavy lifting? Because banks are scared of heavy lifting, because when I speak to bankers, they say, look, when we do heavy lifting and if NPA comes back, market guys come and punish our stock and we are unable to raise capital then.
So Nikunj, I think that is the real problem. I just as a backdrop to that, in the last 18 months, since the ILFS crisis, 6.5 lakh crores has been pulled out of NBFCs by the mutual funds and the banks. So you've actually had a reversal of financial inclusion. For 15 years, the RBI, the second most used word by the RBI was financial inclusion. In 18 months, since the ILFS crisis, you reversed everything of that and much more. So the point is, so it's not just quantum of money going to a section of society, but it's the breadth of that capital that's going out of the system, which is completely reversed. So in my view, RBI recognizes it. RBI has done LTRO2. LTRO2, as you keep talking to companies, is happening in a very small measure. Someone says, I got 1,200 crores approval. Someone says, I got 500 crores approval. But you need to expand that 50,000 crores to 5 lakh crores, to provide some synthetic credit guarantees and give them confidence, give these companies confidence that you're going to have a pipe of capital to go out and lend. I take the money, I make myself comfortable as an NBFC or as a bank, and then I say, okay, now I'll survive the next 6 months. That's not enough. They need that assurance. There is going to be a pipe of capital for you to go out and lend. And two, you need to make sure there are some growth impetus to the economy. If I see the economy is going to keep struggling and there's no fiscal incentive out there and nothing's going to drive the economy, why will I go out and lend? I need confidence that the economy is coming back. And I don't think I have the confidence as a lender today. So you need to have the fiscal working. You've got to have the monetary working. You've got to have confidence in the banker. Give confidence to the bankers that things are going to be fine in a few months and the economy is coming back and jobs are coming back and they'll start lending again. But it's all a function of confidence across the system.
Jeetu, hi, morning. But as an investor, when is it that you act upon investing into financials or largely banks here? Do you wait for that confidence to come back and data points to turn positive? Or do you think right now, when they're getting battered blue almost on a daily basis, this is the time to actually buy into these names?
So I would believe this is the right time. And I'll give you the analytical framework to that. I think the key way to think is, one, what's the market time horizon? What's my time horizon? I would believe the market is looking 3 and 6 months and getting nervous, and I'm looking 12 months and 15 months, and I'm excited. One. Two, where is the thought leadership in the banking sector? Where is the conservatism and quality in the banking sector? Where is the leadership in customer acquisition and building new books in the sector? And who's going to survive and thrive 18 months from now? I think once you have answers to that, and you look at the valuations and the businesses today, I think it's pretty apparent where you'd be deploying capital. And I think this is the time as good as any other. It could be lower by 5 or 7%. It could be higher by 5 or 10%. But I don't think you can time it to perfection. So I would say, spread out the bullets, do it over the next 60 days, 90 days, 120 days, whatever you're comfortable with, but start deploying capital. We could have argued on 1st of April or 29th of March that, there's a lot of bad stuff going to happen and there's more pain to come. The answer is markets are higher than what they were 45 days ago.
Sure. Are you looking specifically at the broader end of the market? Any mid-cap themes that look attractive right now, or are you market cap agnostic?
I am market cap agnostic. I think there's a lot of value and there's a lot of opportunities in businesses that are cyclically impaired today. They're structurally fantastic businesses, but they're cyclically impaired because of the COVID crisis. I think it's a huge opportunity to go out across the market cap ladder and figure what you like. I think the key point I would not compromise on is quality of management, quality of the business, thought leadership in trying to come back, structure of the balance sheet, and also what's your leadership position in the businesses. There are small cap businesses with 50-55% market share in a particular business. And just because the size of the business is small means the guys, it's not a large cap or a mid cap. So having said that, do I think this business, which normalized ROE of 18% is now struggling at 5 or 6, will that come back and will markets price that again? Absolutely. There are a lot of such opportunities.
Okay. Jeetu, how would you place us in context to the rest of the world at the moment? I understand what you're saying in terms of what's required to get economic activity going again. But in terms of putting us into the global context, how would you place India?
So I think, are you talking about markets or are you talking about COVID?
I'm talking about markets.
Well, on a market standpoint, I mean, if you look at what's happened in the US, you take the top 5 stocks, which are the FANG stocks, and see what they've done. They're probably at an all-time high. And then you go and see the bottom 250 stocks on the S&P, and they're completely battered. Okay, so the point is, just because of this heavy weighting of the top 5 stocks, it seems like the US has done beautifully and everything's hunky-dory and everything's fine. And the same thing you're seeing in a lot of different markets. So I would resist from going out and saying, oh, look, the US is fine and India is not fine for these reasons. I'd kind of go out stock by stock, business by business, and see what's happening. And I think the trends are reasonably similar. So if you see the banking sector in the US, including the JP Morgans and stuff, they've been battered. Are they coming back? Yes, they're coming back. There are a few guys that are coming back and a few guys that are impaired. And I'd go out and say that's true for a lot of parts of the world, even including in Europe. If you see some of the businesses in Europe, some of them are hurting really badly, and some, there's a fair amount of confidence that they'll come back. So I'd kind of resist from going out and making big market calls, but I'd kind of say, look at opportunities across markets, and you can see there's a fair spectrum of opportunity across all the markets.
Jeetu, wonderful as always speaking with you. Thanks so much for joining us and sharing with us an insightful view on really how you feel things should pan out from here.